Paulsen, we go way back, obviously, and correct me if I'm wrong, but you in 2018, you got less bullish, and it ended up being a pretty flat year, I think. Now, against a lot of the grain, you've been really pretty positive in 2019, and you still are, I think, in terms of more upside surprises than downside surprises. And you're still feeling that way even about earnings this quarter.
Well, I think, Joe, that we've been kind of putting the market back together again. With different things, we've kind of lowered the valuation, we've lowered the competitive bond yield. You look, the market is up this year, but it's still a lot cheaper than it was in January of 18, and the competitive bond yield's a lot lower. Financial liquidity, the excess of money growth over nominal GDP finally went positive again in the second quarter for the first time since 2017. You talked about concentration of tech. It was much more concentrated last year. It's now a much more broader participation market this year than it was last year. And then the one missing ingredient, which is why I still think we have more room, Joe, is earnings. They've been kind of flatlined this year, and I do think that the market's going to be determined here in the latter half, not by the Fed, not by the trade agreements. I think it's going to be determined by whether all the policies, juice that we've introduced here, money supply, lower yields, more fiscal stimulus, that's either going to work and the economy's going to do better, or it's not. And if it doesn't, we're going to have recession fears and probably a bear market. But I think it's going to work. And if it works, earnings will start to go up again. Earnings estimates in the street will start to go up again. And they'll be going up from a 2% treasury yield and 2% inflation and liquidity support. And I think that means you probably have another nice leg in the second half of the year.
So, Hank, that plays into what your thesis is, too. And it doesn't seem like it's that hard to understand or to come up with. We're back to Tina. I mean, if rates are going down and if they're going down from low levels, what else is there except for stocks?
Yeah, and absolutely. And not only that, you can get better yield in the stock market than you can in the bond market. They talk about financial repression. You're being forced to go into the stock market. Well, it's wonderful in the stock market because you can buy these great blue chip companies with better than bond-like yields, and you get dividend growth. I'd like to add one more thing, and I totally agree with Jim. Sentiment. Sentiment remains sour. Here we are in the 11th year of a bull market, a historic bull market, and there is still plenty of anxiety and fear. And that shows up more in what investors are doing as opposed to what they're saying. And they're taking money out of domestic equity funds and they're putting money into fixed income funds. And anyone buying a bond fund today or parking money in cash is not expressing their confidence, their exuberance, their optimism, their euphoria. They are expressing fear.
You know, one of the attractive vehicles that I was a stockbroker once, but converts, like whether bonds or preferred or whatever, you know, they pay a nice yield, and then there's the underlying common stock goes higher, and then that goes higher as well. But there's always a premium over conversion. When you buy a yield stock now, there's no premium over conversion. You're getting a bond-like yield, and you get 100% of the upside, and there's no call features where you get called away if it goes way above par. I mean, that's almost like giving things away, isn't it, Hank? That's pretty good.
It is truly one of the great features of being an equity investor. But, you know, there's no free lunch in this business. You have to be willing to put up with volatility. Let me give you an example. We bought BlackRock in 2013. It was yielding 3% at the beginning of 2013. Today, our yield on cost of that original position is over 8% due to dividend increases.